Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money. How to make it, how to keep it, and hopefully how to help it grow. Let me tell you what we've got in store for today's show. First up, we're going to be talking about the market decline. We've been talking about the possibility that it could happen for some time now. And as of this taping, we've had definitely a market decline. So we're going to talk about the numbers. More importantly, I'm going to talk you off the ledge and tell you why you really shouldn't be panicking if you are panicking. If you're not panicking, you may want to just tune out for this. In our second segment, we have my friend and colleague Grant Brown. He's a retirement expert, retirement plans expert with compensation planning. We're going to be talking about what employees need to know about their employer-based retirement plans. We've had Grant on before to talk about self-employed plans. This time we're going to be talking about what probably covers more people, which is employer-based plans and what you need to know about those plans. In our third segment, we're going to be talking about something interesting, which is the growing importance well, it's all interesting, first of all, folks, but this is particularly interesting to me, which is the growing importance of financial apps on smartphones. More and more people are using various applications on their smartphones to help manage their personal finances. So I want to talk about this trend, talk about how common it is, some of the tools that people are using, and so we're going to cover that. And finally, we got a great question from a viewer that they sent to us on Facebook regarding whether or not they should convert their traditional IRA to a Roth IRA. So we're going to tackle that at the end of the show. So let's jump right into it with the market downturn. So as of the time of this taping, and this is probably about 10 to 15 days old, depending on when you're watching this, the Dow has dropped pretty substantially. In fact, and we've talked about this on the show before, stock market investors, we have all kinds of different definitions for different things. So a market correction is a decline in the major averages by 10% or more. So it's official. We've had a correction. And we've been talking about this for a while. Like, when is this going to happen? Because the last correction we had, you'd have to go all the way back to January of 2016 for a market correction. So it's been a while. So it's finally happened. And it happened in fairly dramatic fashion. In fact, on two occasions within 5 days, just a little less than 2 weeks ago, the Dow dropped on two separate occasions by more than 1,000 points. And those two drops are the number one and number two largest point drops in the history of the Dow. Now, follow what I said very closely here because it's important information. You saw splashed across the headlines the largest point drop in the Dow, the second largest point drop in the Dow. And of course, everybody paid a lot of attention to that. And it actually happened on the 5th and the 8th of February. But what's important to realize is those two drops, when you look at it on a percentage basis, and that's really all you should care about is how much it goes down on a percentage basis, those two drops don't even make the top 20 largest drops on a percentage basis in history. So there's a number of things I want you to keep in mind as maybe you're tempted to worry, maybe you're tempted to sell everything and go to cash, stick your head in the sand, whatever it may be. Here's some advice. So I'm going to put up a slide. We're going to talk about these one at a time. First thing, this is totally normal. This is not unusual. What was unusual is the long period of time we went between corrections. We went nearly 2 years between, or actually just a little over 2 years between corrections. In reality, 10% declines, which are by definition corrections, happen on average since 1926 about once every year. So you should expect about every 12 months for there to be at least a 10% decline in the market. 15% declines actually happen about every 24 months or 2 years. And finally, a 20% decline, which would actually be considered a bear market as opposed to a correction, happens about every 3.5 years. So these declines are normal, and this one may or may not continue, but if it does, it certainly would not be unusual. All right, let's talk about the next factor. I mentioned earlier, this doesn't make the top 20. So here are some of the statistics. The 1,000-point drops in the Dow that happened on February 5th and February 8th don't make the top 20 largest drops ever in the history of the Dow when it comes to percentage loss. And so here's some interesting statistics. Those of you that have been investing for a while may remember Black Monday in 1987. That drop, which was about 800 points on the Dow, actually represented a 22% loss in one day. Those 2,000-point drops were just over a 4% loss. So put that in perspective. And consider this also, in 2008, in just the last half of the year during the financial crisis, there were 4 drops of more than 7%. And again, the drops we just had were just over 4, so really insignificant. Last one I'm going to put up really quick here. Time is your friend. I want you to remember that phrase. And keep in mind these statistics as we talk about the idea that time is your friend. Over 1-year periods, if you take any 12-month period in investing in large stocks, there's a negative year about 1 every 4. Any 12-month period, doesn't have to be January to December, any 12-month period, about 25% of the time, stocks lose money. But if you start to look at rolling 5-year periods, it only happens about 14% of the time. So if you hang on for 5 years, you substantially reduce your risk of losing money. What if you hang on for even longer than that? If you go out to a 15-year period, and this really should be the kind of time horizon that people have, and even if you retire, keep in mind, your retirement date is not the end of your time horizon, it's how long you're going to be in retirement as well. Over a 15-year period, there's never been a negative 15-year period for large stocks. So time is your friend. This is totally normal. And this drop, although there's some substantial headlines associated with it, really isn't that big in the scheme of things. So if you're panicking, don't. And if you're not panicking, good for you. All right, up next, we're going to be talking to Grant Brown with Compensation Planning. What do you need to know about your employee-based retirement plan? Stay with us. There's more to come. Welcome back to the Money Pros. I'm joined now by my colleague, Grant Brown, with Compensation Planning. And I like to think, Grant, of you as the retirement plans guru. These things get complicated, and a lot of people think this is what I do for a living, but I actually depend on people like you to sort out the finer points of retirement plans. So we've had you on before, and one of the things we've talked to you about is plan options for self-employed people. And there are a lot of self-employed people out there, but I'm going to hazard a guess that there's probably more people that work for an employer, they're not self-employed, and hopefully they have the option of participating in an employer-based retirement plan. So that's what we want to talk to you about today. So let's start off, and this is first question. I'm amazed at the confusion, and I shouldn't be, because people don't do this every day, and so these terms get all blended together. But from a very sort of broad basis, there's 2 types of retirement plans out there. There's defined contribution plans, and then there's defined benefit plans. Can you just fill us in on what the difference between the 2, and then how would somebody know if they have one versus the other?
Sure. So defined contribution is really just that. It's the contribution that's being defined. So if you're in a plan where the employer is putting in a specific amount for you, so sometimes it's referred to as a 401k or a profit-sharing plan, there's going to be usually a formula that's going to dictate what initially gets put in your account, and then that value is going to grow or decline with the market. So again, it's the contribution that's being defined to the plan initially. A defined benefit, again, is that. It's your benefit, so essentially at retirement, generally it's being defined. So Social Security is the best type of example of a defined benefit plan. Some of the large corporations, historically that was the way that the American worker, was able to retire. They had these defined benefit plans. Those are becoming less and less popular for the large employers. Right. Some small employers still, and municipalities still sponsor those. But
I see it a lot like a promise, like the employer is making a promise with both plans to the participant, the employee. But one promise on a defined contribution plan is we promise to put this amount of money in, and it might be a percentage based on some formula. And a defined benefit, it's a promise based on what you're going to get out of the plan.
Right. And usually expressed as a monthly benefit. So usually someone with a defined benefit plan will get a statement that looks like similar to Social Security. It says, I'm going to receive at retirement age, $100 and something a month.
So those traditional, I think of them as traditional pensions where it's a defined benefit, you retain a certain age of service, those are really going away if they haven't already gone away for large swaths of the American public. So I think what we want to focus on today is the defined contribution plan, because even if you are lucky enough to have a defined benefit plan at work, you probably also have a defined contribution plan. So it seems like it covers a lot of people. So defined contribution plans, what are some of the other names that people might know these things by?
Yeah, so as I mentioned, so 401k, if you're in the nonprofit space, there's 403b plans. Sometimes if you don't have your ability to put in your own money as an employee, there's something called a profit sharing plan. So those are the typical ones.
457 plan, I guess, if you're a municipal employee potentially.
Yeah.
Okay.
And again, it's, with the defined benefit plans not being there, Social Security, unclear what the future will hold. It's very important for the employee to take some ownership in their own retirement savings, and this is a great vehicle to do that.
It does put a lot of, and I think that's why we're doing this show, and we've talked about this on Money Pros before, but these types of defined contribution plans do put a lot of responsibility in the hands of the employee that they need to accept, because they really have no other choice, and it's going to be their retirement that's affected if they don't take responsibility. Give us a sense of 401ks, defined contribution plans. How big a swath of the investment landscape is this?
It's pretty huge. I mean, 401ks have been out for about 40 years now, and the retirement assets in general, I read a recent statistic, about 40% of all mutual funds are invested in retirement accounts, be it IRAs or employer-sponsored plans, and 401ks have about $3.5 trillion in overall assets, which is just a massive amount of money.
And we talk about something like we did in the first segment about the market correction. That is where the majority of Americans are exposed to the stock market. I mean, the Dow goes down 1,000 points. It's not generally going to affect your job, your health care benefits, your taxes, things along those lines. Where they're going to see the hit typically is in their retirement plans, like a 401k.
And to your point, it's 15-year time horizon. Your retirement account really is a marathon. It's not a sprint. So if you have it long enough time horizon to ride out the bumps.
But you have to know to do that, and it becomes, we talked about responsibility. It becomes your responsibility to do that. What is the primary advantage? Obviously, it's a retirement plan, but what's the primary mechanism and advantage to a participant of one of these defined contribution plans?
Really, it's an easy way to save. So instead of having to save up money and seeing if you have enough at the end of the year, it's coming out of your payroll. So it's creating a nice, consistent contribution into the market. It creates good saving habits. We always say it's easier to save $20 a week than it is $1,000 a year.
Sure.
And you're, as an advisor yourself, you're getting different price points, to take advantage of dollar cost
averaging. Absolutely. Then there's some tax advantages as well, right?
Right. So you're essentially, getting a savings of, you're not paying taxes today in a traditional 401k, and if you put in $1,000. That's a $1,000 deduction typically that you would be able to take on your tax return. All the money grows tax deferred, and then you're paying taxes when you eventually choose or have to take the money out.
And I think that's a hard concept for people to understand, that if you're going to put $1 into your 401k, because you're not taxed on that dollar, it doesn't actually reduce your take-home pay by $1. It might only cost you 70 cents to save that dollar. Now, hopefully you're saving more than $1. That savings, can be substantial. So it's a cheap way to save for retirement, basically on the government's dime in a lot of ways.
They're giving you a loan, essentially, to invest.
So let's talk about some of the terms and concepts that everybody that participates in a defined contribution plan should know, because they're going to see plan documents and summaries and things like that, and they're going to throw these terms around, and some of them are a little mystical. So let's go through a few of them. First of all, can you pump? It's a great deal. Can I pump as much money as I want into my defined contribution plan?
There is a limit to how much you can put in. For 2018, as an employee in a 401k plan or 403b, 457, it's $18,500.
Okay.
If you're under age 50, if you're age 50 or over in that year, essentially there's an extra $6,000 you could put in.
All right, so there is a limit to how much you can put in. There's also a limit to how much your employer can put in on a matching basis as well, right? But they'll figure that out.
Yeah.
Okay. How do matching contributions work? Because I find this is mysterious to a lot of people. Yeah. How does a plan typically define how dollars are going to be matched, and how does it work?
Yes, and so when we talk about matching, again, another term that's misused, A match is really based on the employee putting in something of their own. And again, refers to the plan document. Every document's different, but a typical formula might be the employer's in a match 100% of the first 3% an employee puts in.
Okay.
But there's, could be 50% of the first 6. Every plan is different. You have to look at the plan description.
So there could be a contribution that's based on what that the employer is making based on what the employee is doing. Then there could also be contributions that the employer is just putting in regardless.
Right.
So we call those
either profit sharing or employer discretionary. So that's not based on you as an employee actually choosing to put money in.
Okay. What is vesting?
Right. So that money that you put in as an employee is always yours. The money that the employer puts in for you, again, depends on the plan document, but a lot of times you have to be with a company for a certain number of years until you're fully entitled to that employer portion. So maybe after 2 years.
So you're going to want to look at the vesting schedule to see how that works. And you're saying it could be after 1 or 2 or 3 years that
and
you're
usually
vested.
Usually 6 years is the maximum that you can have.
Okay. Really quick, 3 questions or one question that people always want to know the answer to, and there's a lot of different ways. How do you get your money out? There's normal distributions, hardship withdrawals, there's loans.
Yeah,
Give us a flavor for what these are.
So again, generally, I mean, these 401k plans are really, the government's created a benefit, so they don't want you to rob yourself of your future, but they understand you have to take the money out. So if you're still working, generally if you have a certain specific list, you can get the money out. You can take a loan, again, depending on the plan document, where you end up having to pay the money back into the plan. But otherwise, typically, it's not until you actually separate from service or hit retirement age that you're able to take the money out. And when you take it out, you have a couple options, either rolling it to an IRA or taking it in cash.
And I find that this is typically when people that participate in these plans, they contact their advisor, maybe their accountant, maybe it's a financial planner, somebody like that, because the rules for taking the money out, when you have to do it, when you can do it, what the consequences are, they get pretty complicated as well.
Absolutely.
All right, so clearly we didn't do this topic the justice that it needs because there's so much detail to it. Hopefully you'll come back and we can talk about it more. Appreciate it. Thanks, Grant. All right, up next we're going to be talking about the increasing importance of financial apps on smartphones. Stay with us, there's more to come. Welcome back to the Money Pros. In case you didn't know it already, applications on smartphones that we usually call apps that apply to personal finance are playing a bigger and bigger role in how people manage their money. I know for me personally, I use a number of smartphone apps, both professionally that help me with my business, but also for my personal finances, applications that any person may have on their phone. So I was interested when I saw a survey from Bankrate.com that talked about the prevalence of some of these applications. So let's throw up a slide and we'll talk about some of what they found out. In terms of the top uses for smartphones when it comes to managing your finances, number 1 was full-service banking apps from traditional brick-and-mortar banks and online banks. 55% of respondents indicated that they have at least one of those apps on their phone. Number 2 was peer-to-peer payment systems. Now, this is something I've been late to come to, but I know a lot of people out there have been using things like PayPal and Zelle for a long time, and 40% of respondents indicated they have at least one of those applications on their phone. Number 3 was budgeting applications. I've been a recommender of various different apps, including things like Mint, that you can put on your cell phone to track your expenses. There's things that business people can use to track expenses, as well as individuals can use to keep track of budgeting and things like that. And 17% indicated that they use that type of app. And then finally, number 4, investing apps. You may have an application from your brokerage firm that allows you to check on the value of your accounts, make transactions, transfer money among accounts, and things like that. I know that's something that I use regularly, and 17% of people indicate that they have at least one of those applications on their phone. So the prevalence of these personal finance apps is becoming more and more common. And what industry experts are telling us is that we've really only touched the tip of the iceberg when it comes to the potential for these applications. Some other things from the Bankrate.com survey: 2/3 of people indicated that they have at least one financial app on their phone. And of those, 70% say they check it at least once a week, and 16% say they check it once a day. It's adopted across generations, so although there is higher adoption for younger people, 64% of millennials use finance apps, 59% of Gen Xers, only 41% of boomers. it is still across a broad swath of the population. And most people would say, and I would agree, that the advantages are numerous. Some potential advantages include things like avoiding overdrafts. If you always know what the balance is in your checking account and you can check it at any time, it's less likely you're going to take out too much money. It's also more likely that you're going to be able to detect fraud if something happens in your account. You may get notifications of certain transactions. You may see something in your account, credit cards, things along those lines. But there are some concerns, and those include security concerns. This technology is new and people are worried about these apps being hacked. And the thing I'm concerned about is particularly people checking their brokerage account applications on a daily basis. The potential for euphoria or depression on a daily basis depending on what the stock market is doing. We just talked about in the last segment how this is a marathon, not a sprint. I'm not sure it's the greatest thing in the world to be looking at it on a daily basis. All right, that's my take on what's going on with finance apps. Up next, a question on Roth IRA conversions. Stay with us, there's more to come. Welcome back to the Money Pros. Great question from a viewer that we received via Facebook, and we encouraged this, and I replied to the viewer in more detail, but I'm going to answer the question here on the air. Viewer wrote in, I have an IRA with Franklin Templeton. I'm 55 years old. It's not something I'll rely on during retirement since I have Social Security, 401k savings, and rental property, but my question to you is it worth converting this to a Roth IRA? I assume I will have to pay taxes up front. Just wondering your opinion. And honestly, my opinion, based on the information you provided, is it could definitely be worth considering the conversion to a Roth IRA. And the logic here is if you're 55 and you're not going to use the money, you may have this another 30 or 40 years before it goes to your heirs. And if you convert and pay the taxes now, that means 30 or 40 years of accumulation that would wind up being tax-free for your heirs when they finally do get it. One thing I would encourage you to consider, though, is you can't use money from the IRA to pay the tax bill that you'll owe when you convert. You're going to have to find that money somewhere else, so make sure you have it. And I would definitely recommend consulting a tax expert because conversions are a little tricky, and if you have to undo it, it's a challenge as well. All right, thanks for watching the Money Pros. We hope to see you again right here next week here on the Money Pros. Take care, folks.